Hi, everybody. Thanks for joining today's webinar on hearing from your peers, transferable tax credits. We are very excited to have both Adam Fritz from Gallup and Jim Fleming from Hormel on the call today. We'll wait just another 30 seconds and then go over a few administrative items before digging into the conversation. Okay, just a few administrative items. So we are recording today's webinar. However, all all attendees are sort of hidden. We do have, we very much welcome questions. Please feel free to put any questions you have in the Q&A at the bottom of your screen. Those questions will only go straight to the panel. So those will not be visible to the rest of the attendees, but we will try to make an effort to answer all of your questions sort of throughout the presentation. If you have any issues at all with connectivity, please feel free to email Dennis with 1N at reunioninfra.com. So with no further ado, we'll go ahead and kick off some introductions or talk about the agenda. So our intent today is to go through the process chronologically from start to finish of a tax credit transfer from the buyer's perspective. This webinar has been exclusively sort of been marketed to fellow tax credit buyers, and we thought hearing from your peers would be very helpful, as both gentlemen here have done a number of transferable tax credit deals. So we'll start with planning, which involves a lot of the internal conversations, getting buy-in and approvals, move towards origination, so finding the right deals that match what each buyer is looking for, and then we'll move into structuring and negotiating the term sheet, and then moving towards due diligence and closing of the transaction. We'll leave 10 minutes of questions at the end. So to kick it off, we'll start with introductions. Why don't I hand it over first to Jim to give an introduction on himself.
Yeah. Hi, everyone, and thanks to Reunion for the opportunity today. It's a pleasure to be with everyone. My name is Jim Fleming. I'm Director of Tax at Hormel Foods in Minnesota. And we've been pretty active in the market for the last couple of years. We do pay tax. So this for us is a great opportunity to get some cash tax savings and also get an ETR benefit. So for us, the program has worked out really well, and we've been active, and we'll continue to do so.
Thanks, Jim. Over to you, Adam.
Yep. Adam Fritz, tax lead at Gallup. Happy to be here. Really looking forward to the conversation. Thanks again for Reunion for putting this on. Gallup is a workplace consulting global market research company. You might know us from our world poll and Clifton Strengths if you ever done that assessment. We really got into the tax credit marketplace in 2024 due to a non-routine transaction that increased our tax liability by quite a bit. So it's one of the few levers that I could pull to kind of minimize our liability or improve cash flow was, being able to buy some tax credits at a discount. So that was really our imperative into getting into the marketplace. And, going forward, we'll be still looking to purchase some credits, maybe just at a smaller amount.
Great. And my name is Andy Moon, co-founder and CEO of Reunion. I've been doing clean energy finance transactions since 2008, so I've been in the renewable energy field for quite some years. At Reunion, I focus very closely on working with tax credit buyers, so working with heads of tax and CFOs like Adam and Jim at mainly large organizations. I'll give a very quick overview on Reunion on the next slide. We are the leading platform for clean energy tax credit transfers. We have done over $4 billion in transfers since the beginning of 2024. And that involves working with, over 125 on the buy side, as well as hundreds of developers on the sell side. We know tax directors are very busy, and this is not the only part of your job. It's, in fact, often a very small part of the job of a tax director. And so we are very, very hands-on in terms of working with buyers through the whole process, from planning and origination through to due diligence and negotiating the tax credit transfers. Let me hand it over quickly to Jim and Adam to maybe say a few words about their organizations and kind of the history of your organizations in terms of tax credits, and that could be broader, your broader tax credit sort of involvement, whether that's state tax credits, other tax credits, and also what you've done so far in the transfer market.
I'll go. So for Hormel, like I said, we are a cash taxpayer. We have a liability, pretty sizable liability. We are primarily domestic. So we do have foreign tax credits, but they're not as large as maybe a lot of other companies. So in the past, our main tax credit has been R&D credit, and that continues to be the case. However, when the opportunity on the transferable credits came up, that was just something that seemed to fit our profile, something that we could find deals that we were comfortable with, and we found some good partners as we went along the way. And so for us, it was good about finding good deals, which we were able to do using firms like Reunion to help us navigate it. And then once we kind of got into it, we realized it wasn't as hard as we thought. We partnered with some good people to help us, and it's been pretty, successful for us so far.
Great. Thanks, Jim.
Yeah, for Gallup, kind of a similar situation. We are a global company, so we have some foreign tax credit exposure. Since we do have a lot of software development spend, so we have some R&D credits there. We actually have some childcare tax credits as well. We have a daycare center on site. It's not too complex, but it's anything helps. And then as far as the transferability credit space, we looked at in the deals that we were able to complete, we completed 2. It was for some 45X advanced manufacturing and 45 production tax credits. That's kind of the extent of where we landed for 2024. But yeah, we again found a great partner in Reunion again to find some credits that fit our risk profile and what we wanted to do.
Awesome. Well, thanks for the introduction. Can we go to the next slide? One other role that we do play is sort of helping to educate the market on pricing and terms. One of the most frequent questions we get is from buyers is whether they're getting a fair deal, and whether that comes from the pricing standpoint or key terms in a term sheet or in a tax credit transfer agreement. We will get into the nitty-gritty details in this conversation about kind of what we're seeing in terms of market. But we will be launching a tax credit pricing and markets platform in about 2 weeks, and that will be publicly available. So stay tuned. Stay tuned for that. All right, so now we'll jump into the main agenda here. So the next slide. The elephant in the room here is that there was this big House tax bill that passed the House last 2 weeks ago, and so given all the news lately about potential changes to tax law and transferability, I thought we could start the discussion by just exploring your reaction to the bill, and maybe we start by just talking generally. How does the bill, which doesn't only address clean energy tax credits, but also talks about a lot of general tax positioning, including R&D expensing, 163J, bonus depreciation. How have those pieces overall affected kind of your forecasting for the year for 2025?
Yeah, I can have this one off. I would say it's probably just delayed some decision making since being able to expense software and bonus depreciation, that would significantly reduce our tax liability, and thus the ability to purchase credits or being even in the marketplace for certain dollar amounts. And it'd be a fairly hard sell to management to say, yeah, let's buy X amount of credits, not being able to use all of them in the current year and having to carry them back. The cash flow doesn't often work that well. So for us, since it's fairly early on, haven't made a lot of decisions yet, but just kind of may delay our decision to purchase 2025 credits to third and fourth quarter, depending on when or if the bill gets through.
Yeah, I would concur with that. I'm just happy that the bill as it stands now after the House has a runway. it's going to be 27 for the types of credits we're buying. I was worried that it would be, I wasn't, there's a possibility of retroactive, but I really wasn't expecting that. But thought there might be a hard cutoff sooner. Originally it was 31 for the credits we were buying, so they cut it back to 27. But I am, what I'm hearing is that some of the senators in red states have investments of this, and they might want to help it out a little bit. So we'll see what happens with that. But for us, I think the harder thing is that we are a fiscal year filer, Hormel. So we're in 25, but it's our 24 tax year. So for us to look ahead to next year, we really have to kind of take and as Adam is doing as well, you have to model out what your needs are going to be. And when you figure additional bonus depreciation, when you have the amount of unamortized R&D expenses that you've added back that you can take, your liability is going to be lower next year. So what does that mean? So it's really kind of hard to commit and really know where you stand in terms of what your needs are going to be. And that's kind of the hardest part, because as Adam mentioned, the carryback, there's costs associated with that in terms of time value of money and just time in general. So we'll see what happens. I'm just, wondering what else changes in the Senate part of it before it all passes and what that's going to mean for us.
Sure.
Yeah.
And in the House tax bill, kind of all three of those trifecta elements, 163J, bonus, and R&D, will have the impact of reducing corporate taxes. Do you anticipate any changes to that in the final version, or kind of are you moving forward with the assumption that kind of those will stay as is?
I'm moving forward as that they'll still be there.
Yep.
Yeah, I feel like there's, especially bonus in the 174, I think there's enough support that I wouldn't think that would get taken out.
Makes sense. And Jim, to your point, we certainly did hear as well. I think some buyers were on the sidelines because they weren't positive that there wouldn't be a retroactive sort of clawback of credits. And we've certainly seen a pretty big uptick in buyer activity since the House bill came out, because I think there's confidence that 2025 credits will certainly be respected 2026 as well. What was the internal reaction from your colleagues and sort of within the company after the House tax bill? Did you get a lot of questions about, hey, you guys bought these credits last year, is there an impact? Kind of what was the internal reaction from your companies? Maybe start with Adam.
Yeah, I think I brought it up to our director of accounting just as an FYI, saying, hey, they're doing some things with transferability, but told them doesn't impact what we bought in 2024, likely won't impact the credits that we're looking to buy, since we're more looking at the PTC side, in the near term, but there is, a runway in the future. So that was as far as it got. There wasn't much else there internally.
Yeah, same for me. I mean, we think it's important to keep your CFO involved and informed of what's happening, and we have to have a trust there. So they trusted us to get involved in the credits, and they're trusting us to navigate the changes.
How would you summarize the overall impact of the House tax bill on kind of the volume of credits you'll plan to purchase in 2025? Has it significantly reduced it? Has it kept it the same? Maybe Jim, start with you.
I think we're going to need less than we thought we were going to need. So we are. That's the hard part, is just knowing. Originally, I'm like, okay, we can always carry it back. But then as you get in and talk to peers and you find out the IRS is taking a long time to pay refunds, it's like, well, then what does that mean for you? And is that prudent to do it? So, we're trying to really lock down where we think we need, and it's just really hard to do that right now.
Yep. How about you?
We're in the same boat. We even considered buying some additional 2024 credits right around, April 15th extension time, and considered buying them and getting a quick refund because we had excess, but, even had heard that IRS was being delayed in processing quick refund applications, taking 2-3 more months than it needed to be. So yeah, we're in the same boat. If with the 174 expensing and bonus, we would be in a much smaller need for credits in 2025 and future.
Have you heard any chatter on, for folks that are doing a carryback, how long that refund might take? Like how many months?
No.
I just heard it's taking a while.
Yep. Why don't we move towards planning? So talking about the process of gaining internal buy-in on purchasing tax credits in the first place, which obviously you both were early to the party. I'd say amongst corporates, you were definitely early movers. Who in the organization sort of ultimately, who in your organizations need to be involved in the tax credit transfer process, and who ultimately has the authority to make the decision on, yes, we're buying the credits? Maybe start with Jim.
All right. Well, for us, what we did was kind of laid out the basics with our CFO just to see would she be interested in this type of program. We recommended it because again, we're paying cash and we can pay cash. We pay less cash and get an ETR benefit. That sounds like a good plan. Not knowing how the deals would work, that was kind of an unknown. But after we got buy-in from that, then of course you're getting your treasurer involved and your legal team involved. Because legal has to, they're part of the contract team anyway as you go. And then for us, what's a fiscal year filer, payment of cash is important because if we're buying from a calendar year company, we're basically prepaying. They've already produced their credits and they want to get paid for them, which makes sense. And we're going to spread our payments out over the quarters. And that made us kind of have to think about some concessions. When are we willing to pay and how much are we willing to pay and how do we find sellers that match with what we want to do? And, that was kind of the biggest part for us. But once we got everybody involved, everybody supported it and we just moved forward.
Yeah, we certainly have, many calendar year buyers where they're very focused on not going out of pocket at all to make an investment. But as a fiscal filer, that's obviously more difficult. Because as you mentioned, the seller wants to get paid earlier, whereas you ideally would pay later.
Yeah.
Adam, can you talk about your internal process?
Yeah, similar process to Jim's. I first brought it to our director of accounting. I actually, thought about it at the TEI annual meeting in New York. And, at first wasn't, that interested in buying credits, but knowing that we were going to have this transaction that had a lot of liability, I think it was one of the things I could do to get some cash savings for the company. And it was really just kind of an education for everyone, being a tax department of 2 people. It was kind of on me to do the research and learn about it and then communicate that effectively with VP of Finance and CFO to get them on board to show them in theory how a transaction might work at a certain dollar amount. And then it became easier once, we had an opportunity at hand. I could show them, here's how the cash flow would work. Here's when we would be making payment versus if we were making normal estimated tax payments. So, it involved multiple learning sessions, just about what types of credits are out there, some of the risks, just making sure that everyone was aware, in case things go wrong, what could happen.
And Adam, when you currently do a transaction, so say you bring a transaction to your to the table, what signing is required at the term sheet stage and at the actual contract stage? Does your CFO have to sign off or board, or kind of how does that approval work?
Our VP of Finance is the person who would sign off on it. We would make sure the CFO is aware, and then eventually, once a transaction was completed, make the audit committee aware of what we were doing. But once we kind of educated the group on how these work and felt like we had done my due diligence on certain transactions, they were comfortable with getting the VP of Finance to sign off, and we have legal involved as well. I think once we got down the road to after we did one transaction, our internal legal team kind of took a back seat, and we worked mostly with outside counsel to do all the due diligence, et cetera. But yeah, that was kind of the process.
Great. And same question for you, Jim. Who's required to sign?
Yeah, our CFO signs the term sheets and the contracts. So that's why it's important to keep her involved and informed. But same process, you got to get your legal team. Our legal team isn't, we do have outside counsel who's taking the lead on it for us, but our legal team is, when we have phone calls with our counsel, they're on the calls and we're going through the terms together So that it kind of cuts down another step later. They don't take into, they're involved throughout the process. So, by the time, again, having done a number of these by now, people do know what to expect, and our profile of the type of deal we're doing is consistent.
Yep.
So it's not like we're bringing new and strange things to the table that people haven't seen before.
Right. And I think that's key. And we'll talk about this later, but especially at the term sheet stage, there's a lot of competition for desirable deals. And so being able to move quickly and have that sort of pre-buy-in from the stakeholders is pretty important.
Yeah. And another thing that we did that I'll mention probably a couple times before we go is one of our strategies from the get-go was to determine good selling partners that we could do repeat business with. And that makes it a lot easier in year 2 or year 3 and going forward that, we have the contracts already kind of out there. We know the terms,
Yep.
there might be something unique to it, but for the most part, they go really fast then.
Yep. Let's talk about the key metrics that are important to you when you're making a decision on whether to purchase a credit. Different organizations have different views here. We did a survey and we heard, actually a minority of buyers look at IRR. They tend to be fiscal filers because fiscal filers have to go out of pocket. But I'm curious, what's the metric that you both use? Is it IRR? Is it absolute dollar amount of cash savings? Is it the timing of the payment? Maybe start with Jim.
Yeah.
What are the key metrics?
I would say that from us, it was more about ETR benefits and then related to the cash tax savings, which generates your ETR benefit. Those were probably the things that keep us at the table the most. But you're right, because of our fiscal year and the cash flow timing, we have to take that into account. So we have modeling that we have to do, and we have to make some decisions on, it has cost us to prepay our taxes more than we would, but we found that the sellers they'll work with us the best they can to delay some payments. So that helps us. And then again, looking at, for us, we want quality sellers. We want guarantees. We want to make sure that the company's solid, can make us whole if there's a problem. And there's a lot of those out there, so that hasn't been a problem. And then for us, it's just been about being comfortable with the sellers and then getting to know them. And because you can do these deals, but you really have to view them as a long-term relationship because of potential audits. And if you have audits, you're going to need to be working together.
Right.
And you've got to maintain that relationship.
Yep. So would it be fair to say that ETR is the main consideration? Timing of payment is a secondary consideration for you? Okay.
Yeah.
And is there a maximum on the amount of prepayment, like in terms of months you're willing to prepay? Is there kind of a high end there, or is it kind of case by case basis?
It varies by the deal. Some of the deals are smaller dollars compared to bigger dollars. And if it's a bigger dollars, we're trying to get pay in tranches.
Mm-hmm.
So, I mean, it's all vary. Every deal's different.
Makes sense.
And it depends on our needs too.
Yep, absolutely. Adam, how would you describe your key metrics?
Yeah, I would say, kind of 1A and 1B would be kind of what kind of discount can we get, with kind of the non-routine transaction. I think initially when we were getting in early, I was definitely trying to find something with a good price to get us the most bang for our buck in terms of, outside legal costs and making sure we're covered on that. But, internally with management, I think the timing of the cash flow was the biggest thing, since we did have a cost of borrowing at the time to make those kind of payments. So it was making sure that they understood, if we were making a payment for the credits before we actually had to make some estimated tax payments, how did that modeling look in both scenarios with or without the tax credits? So that was the biggest, kind of hurdle to get management on board, was feeling like we didn't have too much outside of pocket costs in terms of prepaying more than we needed to.
Makes sense. Last question on the planning process. Do you have any advice for other, tax credit buyers that might be on the line here on, how to get internal approvals or how to overcome potential objections from internal stakeholders?
Go ahead, Adam. You can go first.
Go first. Yeah. I think just communicating as much as you can and just being upfront, not sugarcoating anything. You want to make sure that they know everything that you know, and maybe they won't care about some things, or they might care about things that, aren't an issue that you don't think is an issue, but you have to kind of explain it. So I think just kind of staying in front and just communicating as much as you can is the biggest thing that I found.
For me, when we first presented this, it had a 10-year window to do it. Now that window is substantially shorter. So going for people who haven't done it before, that might be a little bit of a detriment to be able to sell it. But, we just laid it out as why it made sense for us. And, once we got approval, and being a conservative company, we went on conservative deals. So, we're just very pleased with how everything has worked out. And, we can, like I said, we'll continue to do it. But as far as advice, you just have to have your process. You have to know your profile. What are you comfortable doing? And if you know that, then you can find a deal that works for you.
Yep. Let's keep our fingers crossed, Jim. There's a long negotiation in the Senate, so let's hope that this program gets extended. All right. Let's talk about origination. So perhaps a bit of a loaded question given our work together, but maybe you could both share your process of, how you sourced tax credit investments. Like how do you find opportunities and deals? Maybe start with Adam.
Yeah, this is really easy, and this isn't, just a plug, but I mean, we use Reunion to kind of find deals for us. Whichever broker you're using or however you're sourcing them, I think just communicating the types of credits, like Jim mentioned, the types of credits that you want, kind of the general price that you want to pay for them, and what type of buyer you're looking for, I think is the easiest way with whoever you're working with to, get yourself out there. And so that way sellers know that you're out there. That's been the best thing that's worked for us. And some of them have turned into deals, and, some opportunities, not so much. So, you just kind of got to take the both winners and losers at the same time.
Yeah, I mean, it's a lot easier having Reunion and other firms like that who can match buyers and sellers. But when we started, we didn't know Reunion, we didn't know anybody. We did cold calls to energy producers and said, "Hey, are you selling credits?" And that kind of got us into a network and said, "Hey, well, we've sold our credits, but we know of X company that may have some," and they gave me a name, and that led to some direct relationships that we still are having today, which is fantastic. But now it's very easy because of the number, the increase in the producers and the increase in the buyers. There's just more activity, more options, and that's where like Reunion and the like can match people up. And once they know you, that's been really easy for us too, is once you get a relationship with a company that gets to know you, they know your profile, so they're not going to be wasting our time by saying, "Hey, we have this real controversial credit, but you might be interested in it." They don't even bring those to us. It's more like, these are the ones that you guys have bought in the past. These are ones we have. What do you think? Very low key, no pressure, and it works well.
Yeah, I think Adam made a really good point about sort of having a very clear description, providing a very clear box around what you are looking for and maybe what a deal breaker is. We have people that say, "Hey, I only want, a single asset that will take most of my tax appetite," or they'll say, "I only want to do PTCs or ITCs. I want a big discount." Maybe you could talk a little bit about maybe starting with Adam, like what are some deal breakers that in your mind as you look at opportunities? Are there categories that you're very focused on wanting or not wanting when you look at a credit?
Yeah, I think for Gallup's risk profile, we focus mostly on PTCs, mainly just because of the recapture period on the ITCs. We did have one deal that kind of went sideways at the very end that had some ITCs on it, and so going through that process, it made management rethink: is it worth getting another 2 cents on the dollar per credit for that level of risk, where we have to rely on the developer producer continuing on for X amount of years to get past that recapture period? So kind of that's one deal breaker. And another deal breaker is, if there's kind of a gray area where a tax opinion's been issued and you're really relying on that insurance, if there was ever an audit, that's a deal breaker for us. We don't really entertain that, because then you just have to deal with trying to get insurance proceeds, and that can get kind of messy.
Yep. How about you, Jim?
Yeah, similar. For us, the quality of the seller, we want those guarantees directly from the seller. The seller can get insurance, but we'd prefer that they also have guarantees. That's something that themselves, and then insurance is a backup for them. But so that's something that we look for. We have done the PTC, ITC deals with no basis step up, as I mentioned. We haven't gotten involved even before these credits with any tax equity financing or anything. We have stayed away from those more complicated deals. And then it involves insurance as well. We are not interested in taking insurance out at all under our name. One of the things we learned from our accounting firm, our audit firm, was that if you have insurance on these deals, that you then get into derivative accounting on the transaction, which is more complicated, and our accounting team we don't want anything to do with that. So if we can avoid it. So we stayed away from getting insurance ourselves. So that's has been a deal breaker for us too.
And Jim, when you're talking about strong guarantees, what do you look for in the seller? Is it a credit rating? Is it strong balance sheet? Kind of how do you evaluate
Yeah,
whether a
all of the
seller should?
above. I mean, we're looking for the strong rating. We're looking for the balance sheet. We're doing some diligence on that. And then it comes back to the indemnities and guarantees in the contracts.
Makes sense. Great. That sounds good. Why don't we shift gears and talk a little bit about sort of structuring and negotiations, given that you've both done a number of deals. How have you approached, price discovery and really understanding and knowing that you are getting a fair deal and a good price? Maybe Adam, we'll start with you.
Well, easiest way is if, the price that you first throw out to the seller, they don't agree to it. And that's a good starting point. But, I think, we used, Reunion and, as kind of a starting point of, thoughts on what, they might be willing to get the price for, just kind of keeping up with market research on where average prices are at. With the amount of credits that Gallup is looking at, we were on the smaller end. So we knew that, we weren't buying a significant amount of credits. So the marketability was a little bit lower. So we felt like we could offer a lower price initially. And, I think just going kind of through that process, made us feel good that we were getting a good deal for what we were looking at.
Well, I think one related point there. So let's talk about some of the biggest negotiation points that come up in the documentation stage. And one is definitely reimbursement for third-party expenses, which are typically legal, potentially due diligence as well, if you choose to work with an additional outside firm. How have you approached sort of requesting reimbursement for expenses? I'll just give a quick background, which is that when the market first started, often there wasn't any reimbursement for expenses. It was each side paid their own fees. But as the market has evolved, I think more and more buyers have pushed for not having above the line expenses and getting reimbursed. And so pretty much on all deals we work on now, the vast majority of deals, there is a capped level of reimbursement to the buyer for any out-of-pocket expenses from third parties. So yeah, would love to hear how you've approached that in your negotiations. Maybe start with Jim.
Yeah, I mean, that's something that we ask about, and it's there for many of the deals, which is nice. And we've used the same legal firm, outside firm counsel to help us, and so they've gotten to know us, and our deals go more quickly now. But each of these deals is unique. You're dealing not only with the company, but you're dealing with the personalities of the people involved, and that varies by deal. Generally, so you have to treat this as an M&A deal, and And it's not the size of the deal doesn't matter. Sometimes the smaller deals are more complicated or take longer to get through than a bigger deal. But when we're looking at those transaction terms, again, it's for us, one of the things that is kind of current now is change in law in your contract. Before that wasn't something that we had in our deals. Now we're asking about that. Some people are pushing back on that, and now that the House bill is out, pushing back a little harder. But for a while there, people were considering that because what happens if you enter a deal and it gets retroactively taken away? You want to protect yourself at all costs, both sides. So that's just something that you have to take into account. You have to be creative and think of all the things that could happen and make sure that you're protected.
Yeah, absolutely. Adam, any comments on reimbursements or change in law?
Yeah, reimbursements is something we have in the term sheet right away. It's just maybe some flexibility on the dollar amount depending on the complexity of the deal, the size of it. I think in the first transaction we were involved in, both us and the seller, this was our first transaction. Still, this was in May of 2024, so still relatively early, and both sides were trying to figure out what a term sheet should look like. So I would say there was maybe a bit more back and forth on reimbursement and some of those other things like tax contests because both sides were trying to figure it out. But then after that first transaction, Andy, to your point, it's kind of a standard template created, I think, that a lot of buyers and sellers were familiar with. And so it made it much easier later down the road.
Yep. I'll toss out just a few numbers that we've gotten because somebody's asking about what's the typical, I think everybody wants to know what's a typical expense reimbursement amount. I think on the very simplest deals, we're seeing kind of on the low end, $30K reimbursement, but I'd say that the majority of cases we're working on, it's kind of $50 to $150, $175,000 in reimbursement. If the deal is particularly complex, a large portfolio, we do see some that go, above 200, 250K. Pretty rare to see things go above say 300, but that's kind of what we've seen. Does that generally jive with kind of your experience?
Yeah, I would say.
Yeah.
More on the lower end because our deals are more simpler.
Right.
They're easier to get through.
PTC. Yep.
Yeah, same here.
Makes sense. One big point that's come up is tax contest. I think that a lot of the sellers are saying, hey, if we're providing a fulsome indemnity and a no-fault indemnity where we'll make sure you're made whole in any event of a loss, they do want the ability to pursue litigation if the IRS does challenge. And that's something that we've seen buyers push back on. Curious where you've ended up getting comfortable on the tax proceedings question. We'll start with Jim.
Yeah, that's an interesting question. We are in the CAP program. So for us, there's a very good chance we'll be audited before the sellers will be. So, there'll be language in there as who controls the audit. If it's our audit, obviously we want to control the audit. If it's their audit, the sellers, they'll want to control it. But the thing in there that I find that the hardest to get my arms around is how far do you have to go before the indemnity provisions kick in?
Yep.
Do you have to go to the Supreme Court? Do you have to go something that far?
Yeah.
And that's where it gets tricky because you don't expect that to happen. But if, as a buyer, are we going to litigate this? Probably not. I don't know, depending. But as a seller, they have a more vested interest because they produced it and they have, they may feel more strongly about it and they may want to go further. So then you need to, make sure your language allows that, that you're in a kind of a comfortable spot between you. It's tricky. That was probably been the hardest spot for me in terms of the contracts as to how far do we want to go with that? Because some people do push for going a long way in the court system before you get to, indemnities to pay you back if there's a problem. And that can go on for years.
Right.
Yeah, I think for us, we in the transactions we did, we generally gave the control to the seller, and our thinking was if there is an audit, they're going to have the expertise and the information to kind of handle it. I mean, we did retain, some rights in there. One thing that we were successful at getting in the agreements though is if there was an indemnity trigger where a payment was needed, the seller was required to reimburse us within X amount of days, usually 10 days, so that at least we were not out, if they wanted to continue on with this, we were not out money for an extended period of time. And there was a little contention with that initially. But then once we got comfortable with making sure we wanted that in there, we just kind of stood firm and were able to successfully get those in there.
That's great insight. One other major item that's negotiated heavily is indemnity package. Obviously, the buyer is going to want to make sure that the indemnity is coming from the strongest entity possible. But one question that does come up is limit of liability and whether there's a cap there. Some of the very large sellers just have corporate policies where they say, we can't provide an uncapped limit of liability. And curious whether you've seen that or if you've had to deal with caps on limit of liability on the indemnity front. I'll start with Adam.
Yeah, we saw caps on it. Usually we were able to get, like 120% of purchase price. So covered with, purchase price of the credits plus, any potential costs associated with anything after that. So that was what we were able to get comfortable with and kind of what we saw. Some, one seller, offered even to go above that without prompting. So depending on the seller, they might be more willing to go to a higher amount. But yeah, usually there was some kind of a cap on it.
Yeah, we're seeing the same thing. And, you want, the 120% you mentioned, that's maybe that we've had that, but it's a negotiation point. That's definitely another tricky item in your contracts that you need to be watching out for and what you're comfortable with and what you want to, again, protect yourself. So, when these things could play out for a long time, there's a lot of interest and other things in there that you got to take into account.
Yep, for sure. We have one question from the audience on the quality of guarantee. Given the pending legislation, are there concerns about the quality of the seller indemnity guarantee? So I think the question here is, are there concerns that some of the companies that are selling credits may be in a worse financial position due to pending legislation? And how does that factor into your thinking on the quality of the indemnity?
It's a good comment. I don't believe for our deals that it's going to be an issue, the ones that we've been dealing with and hopefully continue to deal with. Because, we've been really intentional about the partners we are transacting with, but that could very well be an issue for some people.
Yeah, not much to add there yet. I think since we're focused on kind of the production tax credits, that it hopefully reduces the risk there a little bit. But yeah, I think that could be a issue for a lot of buyers out there.
One brief question. Adam, have you done a deal with tax credit insurance involved?
Yes.
Okay.
Yep.
We have a question on whether just providing some context on how comprehensive the coverage is on tax credit insurance. So maybe start with Adam and we'll go over to Jim afterwards.
Yeah, it's usually fairly comprehensive. I mean, there's always a laundry list of exclusions that are in there. So, I can't off the top of my head think of what some of those exclusions are, but the best thing I can recommend is, make sure that you're reading through all of the exclusions. And I think on one transaction, there was, a couple of exclusions in there that we had to talk through and make sure that we were comfortable, usually relating to fraud or something like that. The insurance isn't going to cover that. So we had to make sure we were comfortable with the seller that they weren't, giving us a raw deal or something like that. So that was probably just been the extent of our experience on that.
Yeah, we were trying to get guarantees directly from the seller and themselves, which limits our risk there. But other than that, I would say would the same for what Adam just said in terms of what you want your insurance to cover and what that list of what it could be, what could be covered, what couldn't. Then you've got covenants in your agreements, and you got to be careful that you don't breach a covenant, even indirectly or just it's because it wasn't clear that the other side says, well, because you breached that covenant, now your indemnity is void now. That's something that would be worst of all worlds for the buyer. So you can't, got to be careful with that too.
Yep, totally. We'll shift gears and talk about due diligence. So on our transactions, we get very involved in the due diligence process in terms of organizing all the documentation, the data room, and writing a summary memorandum for buyers to help guide their diligence process. But it'd be helpful to hear from both of you kind of how you balance doing your own due diligence with your in-house resources versus, do you bring on, what other outside resources do you bring? Do you have your law firm or others do additional diligence as well? I'll start with Adam.
Yeah, being a tax department of two people with, me being the one person kind of spearheading it, we definitely rely on outside counsel with experts. We looked at, do we have our own internal counsel focus on due diligence, but it just made more sense to bring in the experts, which we're really glad we did, because I don't think initially maybe had a full understanding of the extent of how much due diligence is needed even for these transactions. So we definitely rely on them. But I think as we went through a couple of transactions, I definitely got more comfortable understanding what we should have and what we need, and was able to do more of it, I think, on the second and third transactions than on the first one. So it's just a learning opportunity, really, for me to kind of go through that. And then, Andy, to your point, Origination does a good job of coming up with a memo and tracking all the due diligence. And we still do have our outside legal firm come up with an outline, just really to kind of give to our auditors to say, hey, we had another third party look at this and they've signed off.
Yeah, we've relied on our outside partners pretty much wholly for this. It's a new program. There's rules where there's a lot of rules as anything else in tax. We just feel like we didn't have the expertise to navigate the complexities associated with it. So we've relied on our Big Four for diligence, but really our legal counsel has done a lot of the diligence. And because our deals are, with ITC, you get a cost seg. If you don't have the step up in basis, it's easier to get your arms around whether or not you're comfortable with it. PTC deals, if you have some production that's been done before the prevailing wage issues come in, that makes it clean. And then you're dealing with production reports, which makes it easier to see, and you can see how much energy they produced and sold, because that's the other requirement, sold to an unrelated party. That makes it easier to do the diligence. And then once you see a diligence report, for something, and you'd have similar deals in the future, you'd kind of know what you're looking for. And then, one thing I would also mention on the diligence side that is the importance. The sellers have to register their projects with the IRS, and you need that registration number back from the IRS. So that goes on the transfer election statement that goes in your tax return. So you make sure that that's something that gets, communicated promptly and within the time frame, so you don't stuck with that one at the end of right before you file your return, you don't have a number.
Right. That's a great point. I think one of the biggest negotiation points, or one of the biggest areas we've had to mediate, is particularly with larger sellers or creditworthy sellers. There's a negotiation around the seller wants to provide less information, less diligence materials, because they're providing, a fulsome guarantee, whereas the buyer typically wants more information. And if there's a third party like a Big Four, they want even more information to do their diligence. What's your experience been there in terms of like getting sufficient information from the seller? Has that been a big back and forth for you?
For us, it really hasn't been. I think there's a little bit back and forth on one transaction where I think, outside counsel was trying to get as much information, and it was more of nice to have versus really need to have. So I think it's just balancing, okay, what do we really need versus are we comfortable with not getting it?
How about you,
Yeah,
Jim?
we haven't had issues either. Things that we've asked for, we've received. And again, it's relying on your partner, your diligence partner who's doing it for you. You got to trust them, and you hope that they're asking the right questions. But and when you see the summary report, you kind of learn the ins and outs of things that you need to check off the list. And uh, you know, we'll see what happens when the first audit rolls around. That's kind of what I'm most curious about.
Yep. Yeah, we think picking the right partners. I mean, for sure, we've seen situations where if you bring counsel that hasn't done a deal before, that could create a lot of cycles and additional expense. So definitely having experienced counsel that's done this, done these deals before can really help make things quicker. Good point you just raised on audit activity. Jim, given that you're, well, I guess, has there been any audit or communication from the IRS yet on any of your purchases for either of you?
Not yet in terms of actually IDRs, but we did just open up a new cap audit year in our opening conference recently. And right before that conference, we got the email saying that we're going to have it. And they had a couple questions in there. And one of the questions was, have you had transferable energy credit purchases? So they asked that question right off the get-go. In the first IDRs, we haven't seen anything yet, but we're anticipating I've given the sellers that we did business with for this year heads up that it might be coming, and we'll see what happens. We don't know. Is the cap auditor going to be the person that reviews it, and we'll just kind of keep it at that level, or are they going to bring in specialists? I really haven't really talked to anybody who's gone through an audit of these credits yet to know. So for us, it'll be a first time, and we'll just have to play it as it goes.
Yep. Adam, anything to add?
Nope, nothing on our end. Haven't filed the 2024 return yet, so we're a ways out probably.
Yeah. And again, that goes back to, hopefully having good selling partners that you feel like you can work with, because you're going to need to work together to get these audits handled.
Yep.
And it's in both parties' best interest to work together and cooperate and, get through them.
A couple final questions before we do the audience ones. As far as the transactions themselves, would you say that they're as straightforward as advertised, or was it more complex, less complex? It'd be helpful to hear your overall take on how complex these transactions have been for you. Start with Jim.
Actually, I feel it probably less complicated than I thought going into them. But each deal stands alone. And sometimes you run into a deal where the terms are a little bit different than you're used to. And you kind of have to decide what you like and don't like. And, a deal may fall apart because of something, but you have to be prepared to walk away if it doesn't match your profile. But overall, we've had some interesting issues come up that we've had to work through on the deals that ultimately did not derail the deals, but they were interesting things. Like, for instance, I'll give you a quick one. With these wind farms, you're supposed to register each windmill itself with the IRS. So that's what the seller did. And then you should get a registration number for each one of those. But the IRS sent back one registration number for all of them. Well, that wasn't right. And, they had to go back to the IRS and get that corrected. And it took some time. But they got it resolved. But for us, we're kind of at their mercy. We knew that it wasn't going to fly without that. And we were hoping for the best, and it worked out. But I mean, there's just some weird things that can come up on deals that you weren't anticipating, and you just need to be ready for them and figure out what you're going to do and be prepared to walk away from a deal.
Yep. Adam, are these as straightforward as advertised?
Yeah, in our experience, the ones that we did, the two that we closed on, they were pretty straightforward, advanced manufacturing, and there were wind production credits as well. It was a pretty smooth process. The first transaction that we tried getting into that ultimately fell apart kind of at the 11th hour. That one was actually quite complex because it involved PTCs and ITCs. I can't remember if there was a step up on that one either. So we kind of dove in headfirst in our first transaction based on the amount that we needed. So we definitely learned a lot from that one because it was so complex. So it can be complex depending on what type of energy, if it's a new technology, that can make it a little bit more complex as well.
Makes sense. One audience question: has the evolution of OECD global minimum tax created any issues for your transfers?
No.
No, yeah,
Yeah.
we're not subject to that, so
Yeah.
I can confidently say.
Yeah. That's yeah, man, fiscal year, we get a little bit more time on that. So for us, but we don't anticipate that any issues with that. It's a good
Okay,
question.
great question. Okay, one final audience question: when applying purchase ITCs towards estimated tax calculations, is it sufficient to have a executed TCTA or term sheet, or must the project also have been placed in service?
Well, I think the projects you're buying are already placed in service because they're producing the energy. So in that sense, it's happening, and you're getting you have to support what they've produced. So I think that's kind of it's
Well,
already. Am I
yeah,
misinterpreting the question?
yeah, I think they might be asking about sort of whether, because the IRS was clear that you can reduce estimated tax payments based on credits you purchase or intend to purchase. So I think
Oh,
they're asking about the intent to purchase, like, are you able
Yeah,
to,
oh,
we
we have
were,
not done anything that we've intended. We've always closed a deal before we've applied
right,
it.
as a fiscal? Yeah,
yeah,
makes sense.
I'm sorry, I
that was
misunderstood
same,
the question.
yeah, same process for us. We weren't comfortable factoring those in until we had like kind of a signed term sheet. We weren't in a situation where we we were approaching a credit and then didn't sign a term sheet and had to scramble to find one. So it just depends on what you're comfortable with, I think.
Yep, that makes sense. All right, we're pretty much at the top of the hour. Maybe one last item is, 30 seconds each. What advice would you give to other potential buyers of tax credits as they look to 2025 transactions? Start with Adam.
I think one thing that we really learned is, do take the process to really negotiate the term sheet. I think there were a couple of instances where we had negotiated the term sheet, got it signed, and then as we were negotiating the tax credit transfer agreement, seller inserted something that we didn't agree to, and we were able to successfully exclude it from the transfer agreement. So I think, you may think like it's taking too long to get the term sheet ironed out, but that can help you in the long run by maybe excluding something that you don't want in there. So I think getting that term sheet ironed out early on can go a long way to making the rest of the process much smoother.
Yeah, that's a great point. Totally concur with that. But also then once you get your company lined up to do this, when you get your CFO and your treasury and legal lined up, for us, it was really about finding good partners for us to work with from the diligence side, from, like using Reunion and other firms to help us navigate it. If you surround yourself with good people, it makes it a lot easier and, uh, makes the process going forward easier as well. And also, I would just say, don't be afraid to get into the market, because now that we've been in it for a couple of years, it's actually exceeded my expectations in terms of how it's played out. Again, we'll see how the audits work, but I anticipated, because we're conservative on the deals, that the audits should be fine. But it's been, a rewarding program to be in, been beneficial to our company.
Well, Adam and Jim, thank you so much for joining us today. It's been a great conversation, and we look forward to continuing the work together in 2025.
Yeah, and if anybody ever has any questions, if you want to go through Reunion, I'm happy to talk to anybody
Yeah,
about it.
yeah, me as well. Always look forward to good conversation and meet new people. So
Yeah. All right.
Thank you both.